Negotiations are underway right now at the White House. Nancy Pelosi and Chuck Schumer are meeting with the President Trump, in the Situation Room. They're trying to find a way to reopen the US government. Earlier, the President took a trip down Pennsylvania Avenue to Capitol Hill, where he was shoring up support from his own party. It was a real lunch with Republicans to keep the shutdown going until he gets funding for a border wall. Through all of this, Fitch rating agency is warning that if the shutdown drags on, it might lower its AAA rating of the US government as a borrower. William Foster is here. He's Vice President and Senior Credit Officer at Moody. It's good to see you, sir. Thank you for coming in. Good to see you. This issue of the AAA, the US lost it some years, well, across all three major agencies. The US lost it some years ago. What's the significance of it now? Well,
there are 12 AAA-rated sovereigns that we rate at Moody's. That's a representation of what's considered, the highest rating possible for a sovereign, which means, when you add up things like economic strength, fiscal strength, institutional strength, et cetera, it's really the highest rating that you can have, and it's the strongest benchmark for creditworthiness for a sovereign.
When S&P, I think it was, who first dropped the US as AAA, the rest of you didn't follow on that occasion. Which was, again, similarly a shutdown and a crisis during the financial crisis. If Fitch was to move and you remain on the outlier, what does that say? Does it mean anything?
Well, I really can't speak to other agencies' decisions.
Right, but I guess but if they move and S&P moves, has moved already, do you not look as if you're a little optimistic?
That's for others to decide. Yeah. But our decision would be entirely based on our methodology and our assessment of the creditworthiness of the government. So that's as much as I can really say.
Yeah, and as you were just saying a moment ago, to you have it currently as AAA stable.
Correct.
The stable means?
It means that we don't expect the rating to change in the near future.
What is it about what you're seeing in the economics of the US that you like, that is, well, I'll let you rephrase that. What is it that is preserving the AAA?
Well, the two strongest credit features for the US really have to do with the sheer size of the economy. At $20 trillion, it's the largest economy in the world, largest nominal GDP, which to us really is an indicator of the resilience of the economy to shocks and the dynamism and innovation within the U.S. economy, which is a very strong pillar to the credit profile. The other, which the U.S. has and no one else has, is the reserve currency of choice for the world, in addition to the largest, deepest, most liquid bond market in the world. And so that really removes elements of foreign exchange risk or government liquidity risk that you see for other sovereigns. What we're most concerned about, if you'd like to hear that too, is fiscal strength. Over the medium term, we expect the accumulation of deficits for the U.S. from about 4% of GDP last year to what we expect to be closer to 8% by 2028 to continue to weigh on the fiscal.
That's an annual deficit.
That's an annual deficit.
Which is more than twice the Maastricht criteria, assuming the US ever wanted to join the European Union. But, under the 3% criteria. So with deficits accruing at the best part of $1 trillion a year, even on such a mammoth economy as the United States, is this debt level and debt projection sustainable?
It is sustainable. Of course, people look at sustainability in different ways, but fundamentally the size of the U.S. economy is such, and the dynamism that it's able to carry a larger debt burden. And as we said, with the reserve currency of choice, fundamentally it does not have some of the concerns that others may have about financing with foreign exchange risks, et cetera. The debt-to-GDP ratio for the U.S., which is an important metric of looking at debt sustainability, is closer to 80% debt-to-GDP, and that's a good comparator with other...
Right, but it's not coming down particularly.
No, it's not coming down.
Far from it. You would have expected post-2008, 2009, and the big crisis then, when everybody's debt... You would have thought there comes a point when you start to get it back down to 60, 70% again.
Right. Well, the U.S., along with many other advanced economies, that debt ratio has gone up quite a bit, obviously. But you're very right. There is no plan right now that we see to bring down that debt stock over time, and that's something that we're very much focused on in terms of the deterioration of fiscal strength and the credit profile. We expect that debt-to-GDP ratio to increase to over 100% by 2028.
Wow. Good to have you, sir. Thank you very much.
Thank you.
Appreciate it.
Appreciate it.
But AAA stable at the moment?
That's right.
Good to see you. Thank you.